Hey folks, and welcome to the Pipnotic Symposium on the 13th of August 2024. Today we are going to talk about liquidity on a price chart and where it is hiding, because understanding where liquidity is located in a price chart is pretty much cornerstone to a successful trading model. And so if we consider a structure of price, let's just zoom out a bit and let's just take this last swing here. So we have from this swing here down to here, and I haven't put any indicators on here just to keep things nice and clear, so no supply and demand software, just completely plain charts. We have the origins, these little dots, but they're just showing kind of major swing points, so nothing major, and you don't need it. Okay, so what we have is we have a high, and this high was formed here, and this high was actually able to move below this low price point here. And when this happens, this is kind of a big deal, and the reason this is the case is because a lot of traders, when they're trading either whatever strategy they decide to use, they typically have their stop losses located under highs and under lows, because this is just a very obvious place. This is what I think most trading books will teach you, is to put your stops at areas where price is most likely not to go. And if you consider like a price structure like that, and price is moving up, and you decided to sell at something here, I mean, the most common practice would be to put your stop up here, because it's not likely the price is going to get there. Okay, so a lot of trading books say put your stop losses above a logical place in the market, and then you have some kind of protection. The problem with this thought process is that a lot of the people who are trading, who are aware of the fact that a lot of people are putting their stops above swing highs and swing lows and other price structures, they know that if price goes through these zones like this, then there is a much greater likelihood of reaction in comparison to putting an entry here and the stop above here. Okay, because they know that this is all liquidity. Okay, so when price reaches, let's say, the top end of the book for this price structure just here, they know that there's going to be a thicket of liquidity located up here, and this is going to, as we've spoken about hundreds and hundreds of times, it's going to cause this imbalance in supply and demand to occur. Okay, and this often results in prices then turning around and moving lower. Okay, and this is where you'll typically see prices break down. And when you see this price structure like this, okay, this is just like very typical vanilla divergence that you'll notice. You'll see some kind of an oscillator. If you're using those, it'll be doing something like this around the same time. And so you have like kind of a disconnect in the peaks and the troughs of these two indicators. You don't need an oscillator, because you can see it on a price chart. But what I'm just saying is a divergence is essentially that. It's price seeking liquidity. And when I was learning to trade, my mentor Chris Laurie would also always beat me over the head with this concept. Price is always seeking liquidity. Look at the price chart till your eyes bleed. So I did, not until they bled, but until I needed glasses. And then this really helped me understand where prices were likely to go and turn, because this is super important. So when you see, this is a really nice example, you can see that we're starting to make higher highs. We're starting to violate the structure in price. We have thin liquidity, which is higher. We have inefficiencies above price. So that's telling us that the thinner side of the market is higher and price moves through thin liquidity easier. Okay, so when you start to see this, we have price that is inefficient, we have price making higher highs and higher lows, and then you start to see things like this. We have lower lows just here. This, precisely this, is pretty much what we're seeing here, just upside down. Okay, so you have price structure where price goes, I'm just going to draw it here, it goes like this, and then we have another run, and then we snap higher. I mean, this is telling us that we are doing this right here. Okay, we're looking for little pockets of liquidity that are essentially the petrol used to fuel the direction of the market as it rebalances. Okay, this is super important. And so what you could do as an experiment or a practice is that you look at a price chart and then you could just mark off areas where prices are likely to turn, and they're likely to turn just above highs and just below lows. And this happens all the time. Here we had another one. Okay, here we had another one. Prices went down and up. This one, price went down and up. This one, prices went to the same level. And so this is also what I refer to as a buy and a sell zone. Okay, you can see that the sell zone is actually just here. And so if we consider supply and demand theory, which I think is quite fascinating, we have prices coming down, coming up, turning away, trying to revisit this, and then moving away. The gap between the most recent attempt to revisit the supply and the supply itself, this is called the sell zone. Okay, this whole area. And the reason it's a sell zone is because this is a zone in which you would look to sell. Okay, this is the best price, and this is the worst possible price, the lowest possible price that you would consider to sell at for this particular price structure. And often you'll notice that supply and demand, they come in zones. Okay, you have the demand, and you have the buy zone. You have the supply, then you have the sell zone. You have the demand, then you have the buy zone. Okay, this is super important and super normal, relatively predictable behavior. Okay, so when price is seeking liquidity in order to fuel the next move, it's going to move between these zones. Okay, so if I just draw a fictitious price structure that looks like this, okay, price is looking to move between different kinds of liquidity. And this indicator is called an origin indicator. It doesn't really, you don't need it, it's not important, but what it does is it shows you the origin of a move. And notice that when price comes up to these little dots, it often moves just beyond and then it turns around. We had another one here, just beyond, and then it turned around. Another one here, price did not get to it. We had this one here, price went just beyond and then it turned around. You see this all over the time. And so what we have is we have a price move, and the price move, let me change the color from here. Let's say it goes from here to here. This is the move, and these are the internal moving parts for that move. Okay, we have liquidity that is at the top and the bottom of the book, which is typically around the top and the bottom of these price swings, like so, around here. Okay, and so this is going to be the top of the book. There's going to be thicker liquidity here. This is typically outside of the range of this swing, and below we have the bottom of the book, and this is typically also a highly liquid place, and this is also typically outside of the range of this swing. And so we know, relative to our little example we saw just up here, the same thing occurs here, that when price moves into an area of demand, which it does all the time, or to a buy zone, let's say we have some demand here. Okay, prices move away, we have an attempt to move back, we fail, prices are extended forward. Here we have demand, here we have buy zone. Okay, and when prices reach the end of a move or they reach the top of the book, they will typically, the balance between supply and demand will again shift. So where we had thinner liquidity above price, if we poke into pools of liquidity at the end of moves, the top of the book, this is going to change things. So the state of liquidity shifts from the thin side above price to the thin side below price. And this is super important to understand. And so when this happens, when price seeks liquidity and finds it at the end of a move above major swing highs, then prices will typically begin to consume the liquidity, the thin liquidity below price, and it'll keep moving until what? When will it stop? Well, it'll stop when it finds sufficient bullish liquidity below price. Okay, so prices come down, they find a buy zone, they find demand, and then they will continue to poke to try and gnaw away at that. And when that imbalance that inevitably will occur begins, then prices will begin to snap up like so. And you can see this on the 1 minute chart. It's very fascinating, and I encourage you to do a study where you mark off, let's say, a 30-minute area, a 30-minute low or a high, or a 30-minute valid qualified buy or sell zone, and go onto the 1 minute chart and watch it as price pokes into it. Have a little zone here. Let's say this is demand. This is a 1 hour demand, like so. And then watch on the 1 minute as it comes down and it kind of pokes into here. Okay, so until the edge of the zone, the thinner side is below. But now we are at the bottom of the book. Okay, we have bids lower. Okay, price pokes into that. So the selling interest, the sellers are consumed by the available liquidity down here. Okay, and you can see it happen. Prices will pop down, then they'll snap up. Sometimes they'll even gap up. Okay, and then they'll stop, and then they'll have a bit of a shock, and then they'll stabilize. Okay, so liquidity is stable, and then they'll have another go, and then typically it'll snap up again. It'll stabilize, and sometimes it can go on many times, maybe 1, 2, 3, 4 times, depending on the time frame. But eventually, when price, I always refer to these as pancakes. Okay, and the sellers are hungry for pancakes. So this price is a fork. The fork comes down. We take the first pancake, so the first pancake disappears. Okay, and then we have another go, and the second pancake disappears. And eventually, the sellers who are eating pancakes will get full. And when that happens, then they stop eating. Okay, and then prices begin to drift higher. And then they do the opposite, where they move to the other side of the market, the other side of the book, and they look for pancakes once more. They'll move up, they'll find a pancake, that pancake will disappear. Okay, and then they'll have another go, and that pancake will disappear. And when the buyers, the hungry buyers, are full, then prices will turn and seek liquidity lower. Okay, this is happening all the time, over and over again, and you can see that happening here. This is a nice example where we have a buy zone right here. We have an area of here we have a parent zone here. We have a child just above it. This is demand. Okay, we have this the buy zone established just here. Prices pull back. Okay, pancakes at the buy zone. We poke in, we snap back. We have another go, we snap back. Okay, where do we go? We go to the opposite side, just here. We poke into that, into those the offers there, and we are now full. Okay, so price goes deeper. We move through the sells, so through the buy zone into the demand, and we find some orders. We snap back. We have another go. We snap back. We go a little bit deeper, almost to this low, and this is where we find. This is where the scale, or the ratio between the buying and the selling pressure shifts. What happens? Prices are heavier lower. Okay, they're thicker lower, thinner higher, so prices just wriggle north, sometimes inefficiently, depending on how many bids were picked up down here. Price starts to break down the price structure. Okay, we seek lower to do what? Seek bids. We find those bids at critical and very precise price patterns down here. We snap higher. We start violating more highs and more highs. Okay, we reach the sell zone right there. You can see it right there, the sell zone. We get right to it and we break down. Okay, we start seeking liquidity lower. We fail. We start to move to the other side. Okay, we find some here. We move lower. We find some bids, some bigger bigs here. So the available liquidity down here consumes the sellers. It consumes them. Okay, so you have people selling into bids down here, and the bids are so much greater than the opposing side of the market coming in to sell, that they are consumed, and price stops. Price stops. What happens? It seeks the other side of the market. It seeks the other side of the market, which we find here. Price stabilizes a little bit. We seek lower. We're looking for liquidity. We have a buy zone. We go lower. We establish a new buy zone. We go low. We gap lower. We snap higher. Imbalance. Imbalance. Stable. So this happens. It goes on and on and on and on. Okay, and so to give you something to work with immediately, look for a recent, the wrong tool. Look for a recent swing. Let me find an example. Let's just go. Okay, look for a recent swing. Let's just grab this one. This is a recent swing from here. We'll do a couple ones, but from here, this one here to here. This is the most recent swing. Okay? Above here, there's a lot of liquidity. Below here, there is a lot of liquidity. This is the top of the book for this price structure. This is the bottom of the book. So any attempts to move above here will be met with sellers. Any attempts to move below here will be met with buyers. Okay? And so what I want you to do is I want you to identify areas of the market where price is able to consume. Here we have a little one. Oops, wrong tool again. We have a little price structure here. Price is tested. We test. We move higher. Where do we go? We move to the opposite side. Just here we have a little price pattern there. Price pokes into it. And we are again at an imbalance, thus trading inefficiently. What do we have here? Well, here we have a low. Okay, what happens there? Well, prices go through and we react. Okay, so we have in here on the 1 minute chart, you'll notice there'll be a little dance. There'll be a little dance where prices move down to this historical low. Let's say this is the line here. They'll move down. They'll snap higher. They'll snap higher. Typically, if an area is going to be removed, what you'll notice is prices will test the zone, test the zone, test the zone, and you'll see the highs begin to get lower, but we'll see a stable level here. What does that mean? That means that the consuming of the bids is going on, and you can see that liquidity at this zone here, what's available here, is slowly being consumed because we are able to make some lower highs. Okay, and eventually they'll be squeezed out and it'll pop lower. Okay, which is what we saw here. Okay, when that happens, prices just continue to drift lower until they meet the other side of the market. So mark off your highs, mark off your lows. Okay, and also, I haven't discussed it in this video, but there's a concept that I use called boxing. And the reason it's called boxing is because I put a box around it. If you go to the channel and you search for boxing, you'll find some videos. Okay, so this is going to be the sell side of the market, and this is going to be the buy side. And what does that mean? That means you are only allowed to sell at patterns that occur on the left side. Okay, going from this high to this low. Any patterns that occur in here, they're only for selling.